you're not in the business of private money lending, think again. If you hold your money in a bank or a credit union, you are already lending your money out. Hear me out. Now, the way that these institutions work is you put your money inside of a bank or a credit union or whatever, and you're thinking, oh, the money that I put in is just kind of sitting in an account waiting for me. So whenever I need it, I can just go get it. But in reality, what's happening, especially if you have your money in a checking account. So we'll look at two different scenarios. Let's say you have your money in a checking account, right? You use it for your bills, whatever. Now, more often than not, what's happening is the bank or the credit union is taking that money that you have deposited and using it for other things. Okay. They are actually loaning your money out to other consumers, to other institutions, so that they can make money off of the money. That's how they make money, right? That is their model. So the money that you deposit isn't all available all at once for everybody because it's being deployed to make more money. Now, when banks give out credit cards, or even, credit unions, they give out credit cards, they give out personal loans, they give out mortgages, home equity lines of credit. Where do you think that money comes from? That's your money, okay? They're taking all the people's money and basically loaning it out for interest, okay? That's how they make their money, or one way they make their money. Of course, in the mortgage situation, if the loan is not repaid, the bank can end up owning the house and someone can buy it from them from auction, and that's just how that works. Now, let's say you have a savings account at a bank. Typically, a bank or a credit union, they're not paying more than 1% for just a regular savings account. What I am seeing is for a CD, so a certificate of deposit, they're offering 4% per year. So that's a 3-month minimum, and it has to be a minimum of $100,000. You know why though? Because they're going to take that money and loan it out, and you cannot take it out before the term ends. Okay. So they want to make sure they're going to have the money long enough so that they can go and turn a profit off of that same money. Now, depending on what term you do, you can get higher interest rates, but the highest that I see here for a CD is 4%, which tells me that for a savings account, it's going to be way less than that. Now that's how they work. You're essentially giving them a loan, and then they're turning around and loaning out your money to other people for a profit. And if you have a savings account, they're paying you pennies, for the loan that you gave them. And if you have a checking account, you're kind of just loaning it to them for free. This is an interest-free loan, essentially, is what it is. And I mean, it's in most cases, if it's an FDIC insured bank, it is secured, right? Technically, having your funds in an FDIC insured bank or financial institution, it's protected up to a certain amount. So in a sense, it's a secured loan, but it's an interest-free loan. Now, another way that I see people doing private lending who don't realize that they're actually lenders are loaning to family members and friends, right? I remember the very first loan that I did was in college, and it was a fellow classmate who was also my friend at the time, needed a root canal actually. And I had a good amount of money in college. Okay. I was on a grant program. I had a bunch of scholarships, and she needed this root canal. And I guess she wasn't on her parents' insurance, and she needed $1,500. And I was like, okay. And, when are you going to be able to give it back to me, whatever? And she was like, oh, my mom is going to be able to pay you back, and it's going to be a few months. She just needs to get her check and blah, blah. And so, naive me, I'm over here like, okay, I don't want you to have a rotten tooth in your mouth and just be in pain. And she was in a lot of pain. And I was like, okay, I guess I can let you borrow this $1,500. I wasn't thinking about interest at all. I had never let someone borrow money like that, especially not that amount. I mean, I probably gave a friend $1 in elementary school, but not $1,500. But let her borrow this money to get this root canal. She got the procedure and everything. But when it came time for her mama to pay me back, no, it never happened. Literally to this day, I've never been paid back for this. And so that was my first private loan experience, essentially. And as you can imagine, very much a turn off. I was like, this is not it. Like, I don't like this. I don't want to do this. So a lot of people experience that though. Like they loan money to a family member or friend. They don't charge interest. They don't document anything. They may have some text messages or something, but they're not really documenting anything. They're not securing it against anything. They're just trying to help somebody out. And that's great. But that is also private lending, right? It's still private lending. It's just you're doing it a different way. You're doing it for consumers. You're not charging interest for the most part. I haven't seen Like when I see people loaning money to their family members, I don't typically see them charging interest, but even if they are charging interest, I do not see them having official documents or anything like that. But they're private lenders too, right? And after that one, I did another loan to a friend. This one was $3,000. So she had been evicted and wanted to save up the money to have it to be able to pay her security deposit and first month's rent, but was feeling like she wasn't going to be able to, I guess, control her mom's spending or something like that, and control her own spending and set those boundaries. So she was like, I'm just going to borrow this money and pay you back, right? Because I think like if I did it myself and try to save over time, it's gonna take too long. So yeah, she borrowed the $3,000. I did not charge her interest, and she paid it back over, I think it was like a year. She made payments every month, and so that one worked out. But that first one did not work out. Okay, but again, I didn't charge interest, family, friends, whatever. But that's still private money lending, right? And so if you keep your money in a bank, if you keep your money in a credit union, if you've ever loaned money to a family member, if you've ever loaned money to a friend, you're a private money lender. Now the question is like, how's that going for you though? Like, are you set up properly for that? Are you making profit from your loans? Can you do this on a different scale and actually make a difference in your wealth building? You know, since you're doing it anyway, why not just do it right and do it better? Something to think about.